What does Halo do?
And so Halo today is a two-sided marketplace that has disrupted and democratized the $3 trillion market of structured notes. If more than 1% of your audience knows what a structured note is, I think I'll put $1,000 on the table. It is the biggest market no one's ever heard of. It's a $3 trillion market globally, meaning there's $3 trillion of structured notes outstanding around the world. $1.3 trillion, not to be too specific, but we are Halo, but $1.3 trillion of structured notes get issued every single year around the world. About 100 billion of that is in America. So ironically, if you do follow capital markets, there's not a lot of asset classes that, America doesn't hold the predominant market share. And, in this particular case, America has always held around 7 to 10% market share, versus Europe that does about 400 billion and Asia that does 600 billion. So getting back to structured notes, is a structured note is basically manufactured and issued by a major bank, like a Bank of America, like a Morgan Stanley, like a Citigroup. Technically, it's an investment package of a zero coupon bond and a derivative. But more simplistically than that, it's insurance around your investment, right? So I always educate people of saying, look, you might buy the stock of Apple, right? Your audience may love Apple. And when you buy the stock of Apple, we all know you get the benefit of all the upside. However, you also get the benefit or demise of all the downside. And that's been particularly challenging in this market because it's been a very volatile market. Your consumer behavior, the pains of losses outweigh the joy of gains 2 to 1. And so to that point with a structured note, what a structured note does is allows you to get the majority of the upside of Apple, where you're not going to get all of it, but you may get 90% of the upside of Apple. But in return, you're going to protect against, say, the first 30% of declines. So what does that mean? Every structured note has got 4 variables. So for those listening, if you can understand these 4 variables, you can understand any structured note out there. The first variable is the maturity date. Every structured note's got a maturity date, like a bond or like a CD, if you ever bought a CD before. That maturity date can be 3 months to 10 years. The financial advisor picks it. Halo is a B2B company. Most maturities are 2 to 3 years. What does that mean is that the terms of the note only matter at maturity. The second variable is called the underlying. Every structured note is linked to the performance of an asset. That asset could be Apple, like I just said. It could be an index like the S&P 500. It could be a commodity, currency, interest rate, whatever you want. We've got 3 billion combinations on Halo. So whatever you want to invest in, I can almost promise you we've got it. But traditionally, people buy structured notes linked to the performance of indices and stocks. Sure. The third variable is the payoff, is the participation rate that I was just telling you about. Hey, I'm going to give you 90% of the upside. I'm not going to give you 100. I'm going to give you 90% of the upside. Meaning, if you had a 2-year note on Apple, and Apple for round numbers was up 100%, you're going to be up 90%, right? And in return for not being up 100%, that 10%, discrepancy, right, versus buying Apple stock outright, is that we're going to protect you against the first 30% of losses. So if Apple's down 0 to 30, you're down nothing. If Apple's down 31, you're down 1.
Really?
And that's the beauty of structured notes. And people say, well, geez, why do I need structured notes? And I always ask, I said, well, do you drive a car? Most people say, yeah, I do. I said, well, you definitely drive a car with insurance, don't you? Because if you don't, it'd be illegal. But why do you drive a car with insurance outside of it being illegal? Is because you don't know. You're protecting against the unforeseen, right? If you own a home or live in an apartment, you probably have insurance on your apartment or your home for the same reason, to protect against the unforeseen. God forbid, hopefully nothing happens, but in case it does, that's why you have insurance. It's the same thing with your investment portfolio. So you have insurance on your home, you have insurance on your car, you have insurance on your dog, for Pete's sake. But you don't have insurance on the most important thing in your life, which is your investment portfolio, outside of your family and children, of course. But from a financial matter, one of the most important things in your life is your nest egg. Case in point of why this is important. Last year, a blended 60-40 portfolio was down 20%. So that's a challenge, right? The diversification of stocks and bonds failed last year. Newsflash. You know what the average retail investor was down according to JP Morgan last year?
What was it?
40.
40, average retail.
Average retail according to JP Morgan Asset Management. 40%.
Oh my gosh.
And so that's double of what the market was a fully diversified portfolio. And so what has happened? A great article in one of the major news outlets earlier this week about, unfortunately, which is this always happens, is that people get spooked. You lose 40%. We're all guilty of it. We're just saying, hey, I'm out. If you're at the blackjack table, it's like, I lost as much as I can stomach, right? So you're out, and now you're in cash. And now you just missed a really nice rally in the first quarter.
Yeah.
And all of that was sitting in cash. At least cash is yielding you 4% if you're at a higher yielding institution. But that's the problem. And that's ultimately the benefit of structured notes, to say, look, hey, if the market's down, you've got the protection. It's okay. So structured notes not only help you stay invested so you don't panic and you don't blow out, you've got the protection. You're getting the majority of the upside. But just as important, structured notes help you get invested. Because now it's like, well, geez, what do? The market's already rallied. Are you going to put your cash to work now? I don't know. I don't have a crystal ball, neither do you. And so that's the benefit of ultimately what these products do, because I could say, hey, now is a good time, potentially, and I don't give financial advice, but now is potentially a good time to still get into the financial markets. But if I'm early or wrong, it's okay. You've got the protection.